I've got a couple general questions to begin with, and then I'll have some final questions for you as individuals. But one of the things several of you mentioned in your testimony was the recent Jobs Act that we passed. And I know the parts that I liked, I know the parts that my colleagues across the aisle liked, but I'd be curious to know is the parts of the bill that stood out as being particularly helpful to each of you, and then perhaps as a follow-up to that, things that you would have liked to seen in that bill that were missing if we decide to take it up again in sort of a 2.0 version next session. So I'll start down here, Ms. Dent, with you. If there's anything about that bill that particularly stood out to you, let's hear about it.
We probably knew best the IPO on-ramp provisions. We had worked on and off with that committee over the course of last year developing the recommendations. And we see the impact that the lack of IPO, or maybe better said, the unpredictability about whether an IPO will be a possibility. It takes about 2 years to get ready for one, and so it's not a question of whether you can pull it off when you're ready. It's a question of, do you devote the resources to trying to get ready, and the cost, millions of dollars of cost, away from all the other things you could use that money and your time to do. So we think that providing a more predictable path, scaling those requirements is really, really important. The other piece that we had worked on, the other pieces we had worked on were, what if you don't want to go public? What if you still are the right size to be a private company? And so the Reg A, the Reg D, and the shareholder limit provisions, we think in some ways the bill was strong because it addressed both halves of from the earliest stage to the latest stage to give people different options. I forget who it was who said, there's no single answer, it's a mosaic. In response to your other question, I guess I don't have a version 2.0. What I loved about the IPO Act was it avoided the desire to solve all problems, and it said, let's get something done. So I think it's great about if you're looking to 2.0, but I think what you really should be commended for is being willing to do 1.0, get it done, move it forward, pass something, and then keep moving forward.
Obviously, for us, for Startup Exemption and myself, it would be the Crowdfunding Act that was part of the Jobs Act, and the opportunity to raise, for regular Americans to make investments in their communities and with ideas, entrepreneurs they believe in and ideas that they love. For a while now, the donation-based crowdfunding space has been in act. So companies like Kickstarter and Indiegogo, where you can go and contribute in sort of the PBS model of, I'd like to donate money to an artist or a filmmaker or a band, and in return for that, I get a prize, and typically that's the movie or the CD or whatever it is that artist is creating. There'll be more money that's donated through those platforms this year than the NEA will distribute this year. So well over $100 million, and that's all been delivered with virtually no fraud. And so there's a real huge opportunity. That's to give you a sense of the scale of what crowdfunding could become from an equity or debt perspective. I think it's a data point to look at. So I think that's one of the things that we're really thrilled about. And again, from the opportunity to say, let's get something done, let's put a stake in the ground and move forward. We're so grateful for that, for taking for really moving forward with a new idea in this way in a really rapid and meaningful way. And we appreciate that so much. From a 2.0 perspective, I think that I would like to ask for the opportunity to continue to engage with you, Mr. Chairman, and this committee during the SEC rulemaking process, because that's where we're really going to need support in making sure that we create a process that does protect investors really well, but also doesn't create so much friction on the process of making these small investments, these modest investments, that it kills the market. So it really is going to be that delicate balance, because so much of, to get a few data points about what's happening today on those donation-based platforms, only about 40% of those, of projects that are posted on those platforms that say, please, we'd like to, please fund my idea, only 40% actually reach their funding goals. So what that says is the crowd is doing a pretty good job of vetting the ideas that they think are good ones and bad ones. My guess would be that as we look at the equity side, that those numbers may be even a little smaller than that. As people really are looking at that, what are my returns, and really taking a very close look at those things. And so making sure, and also typically these investments will be made by people you know. And so your first-degree connections on LinkedIn, or your second-degree connections, or third-degree connections, people who know you or know people who know you. What we see on these donation-based platforms today is you have to get to a tipping point of about 30% of your funding goal being reached by people that know you or know of you before strangers will invest in you. I think that also will be true with equity-based or debt-based crowdfunding as well. And so really allowing this market that's very delicate from a social interaction perspective to take place, I think there's a way to do it and ensure investor and create some prudent investor protections, but just making sure that we can work with the SEC effectively to do it in a way that doesn't restrict the market so much that it kills that market dynamic. So thank you.
The other panel members are much more expert in the Jobs Act than I am, but certainly and we've never had a company that's gone through an IPO, but certainly with the modifications made that would allow some of our companies to perhaps go through that process much quicker and for less cost, we like that feature of the bill. On a personal basis, I like the idea that companies that previously couldn't get access to appropriate amounts of funding to start their companies, because I think there's been comments made on that. It could be more lifestyle kinds of companies. They may never be a organized angel or a venture capital kind of opportunity, but they're companies that if you can put $500,000 or $1 million a year into those companies, they can be very significant lifestyle companies. And I like to tell the story of when I was a part of a CEO group with about 15 members, and we had low-tech, no-tech, and high-tech folks in the group. But the most successful company in the group was a family lifestyle business. It was $250 million in annual revenue. He wouldn't tell us the profits that he made, but I'm sure they were much more significant than the profits we ever made. But that was considered to be a lifestyle company. So the fact that we could get more of those kinds of companies, and probably 80 or 90% of the companies that we have in the country today are lifestyle kinds of companies. So to be able to give them funding to help them get the traction that they need in the marketplace, I think is pretty significant.
Thank you. Again, supportive and complimentary that this exciting new form of crowdfunding can be passed as quickly and soon will be available to the market. Couple of concerns, and we have yet to know if they will be concerns, but this is an area for possible future work. As a large number of investors relates to converting into follow-on rounds, there may be the need for some changes in regulation on some upstream funding to accommodate the crowd-funded invested companies. Again, it's too early, I think, to know whether that's going to be an issue.
Well, and that sort of transitions to my next question. Maybe it's you, maybe it's Mr. Best, anybody else. You mentioned something that was of interest to me. I'm not a new tech kind of person. The companies I've started have always been old tech, very old school, boring companies. But you mentioned the restaurant in Louisiana. Maybe now there's the opportunity for them to use this crowdfunding. I want you to walk through how you'd like to see that work. Ideally, how would it work if you're a small business owner of a restaurant in Lafayette, Louisiana, and you want to do this? And then I'd like your input into what needs to happen during this rulemaking process that we're in the middle of right now to get to that ideal outcome.
So sort of in the best case scenario, I'm a restaurant owner, I want to add a second location. I would go to a website that would be we call a funding platform, a place where all of these transactions will take place. I, as a business owner and equity investment seeker, would then put in a lot of information about myself and my business, my Social Security number and my business information and my sources and uses of cash and some pro forma kind of business statements, accounting statements, so that I'm able to explain fully to my potential investors what I'm going to be doing with that money and how I'm going to be utilizing it. There'll be a video there, like there are on a lot of these sites today, but sort of letting you sort of get a chance to virtually interact with this entrepreneur. And then I would then go out to my social network, both physically in the community, and I love the idea, Ms. Jackson, of creating a physical space for this to take place as well as an online space, but also through my virtual community of saying, to my customers and my friends and my relatives and say, please invest, I want to add a second location. That money would come in over some period of time. Let's say, typically we would say between 60 and 90 days would be a typical window you'd want to leave this open for. And then once the funding goal was reached, because the legislation requires obviously there to be 100% of the funding goal to be reached, if I reach that goal, then the cash call occurs and I'm able to then receive that money and then continue to communicate through this funding portal with my investors. And so there would be, standards required for this restaurant owner to be able to then say on a quarterly basis.
And tell me what those are, because that now we've moved into what has to be done during the rulemaking. So give me the standards. Tell me the type of things that when the SEC calls my office and says, what happened at the hearing today, what's your input, what am I supposed to tell them? What do we want to focus on as we go through this rulemaking process?
That you want to provide the same type of quarterly reporting that would be expected from a bank loan or an investor. Just to provide that basic level of information on.
Does it have to be audited?
The legislation, I think it depends on the level. I think that below $500,000, it's basically should be just a signature of the CEO. Above $500,000, what we've called for is not fully audited, but that it would be certified by a CPA, reviewed and certified by a CPA.
Now tell me, you mentioned something else about it's not charitable, but the other type of
donation-based?
Exactly. And you mentioned something very interesting to me, which is that it's almost completely fraud-free. How is that happening?
I think it's just it's the power of the social web, I guess, is one way to say it. And I guess what that means is it is, to use a term as Dent used, it's an optimistic way of moving into this sort of arena where I say I really want it because people make donations for a number of reasons. They do it because they want the perk that comes along with what you get. Like if you give me $50, I give you my CD of my band. They do it because they believe in the individual, want to help out. They want to be a micro patron of the arts, or they just believe in the cause or the idea, or want to be part of something bigger than themselves. I may never be in a band. I will never be in a band, but I might want to support someone who is. And so those are the reasons that people donate. I think that when you add the equity return piece to it, I think all those things still exist. But you're adding also to it the desire to be part of something bigger that may have a financial return for you.
And do you think that the risk for fraud would be higher or lower? Because you've just described essentially the old-fashioned charitable. You're right. You're a micro patron of the arts, which is a slightly different calculus that you go through versus investing in that restaurant. Do you think when we switch over into that return on equity that the risk of fraud goes up, goes down, or stays about the same?
I think it stays about the same. I mean, there may be some, it's really hard to predict because it's kind of a whole new area, but I don't see it being orders of magnitude different than what we're seeing today with the donation-based platforms. Because I think that the main reason is the disinfectant quality of social media, the ability for the power of sunlight, if you will. If I'm signing into these platforms, both as an investor and as an entrepreneur, and I'm signing in with my online identity, and all of my network is there, it's really hard to hide. It's not because in the past, the fraud that took place was I knocked on a door, or I made a phone call, or I sent you a one-to-one communication email that said, I've got this great idea. This is you putting yourself out in front of the entire web, with all of your social connectivity watching. And there'll be online rating systems, just like there are on Amazon or on other websites.
So it sounds like there's a strong argument for a fairly light hand when it comes to prophylactic fraud prevention. Since because it's people that you know, because of the forms that you're moving in, that I guess I'm trying to make an argument for you that the SEC and whoever else gets involved in rulemaking should not go too heavy on trying to anticipate fraud, and hope that perhaps the market will insulate itself against that to begin with. Okay, that's great. Ms. Dent, very quickly, and I don't want to have a hearing and mention the words IPO and not have somebody say something about Sarbanes-Oxley, so you win by default. Because I'm going down I've got my angel investor, my crowdfunder. You're the closest we get to IPOs, and you actually mentioned it a couple times. Is it working? We all know that formation of public entities is at an all-time low. I think it was you who mentioned, I think accurately, that it is when that company gets over that hump and becomes public that we see the dramatic increase in jobs, because the access to capital allows that company to grow so dramatically. So how are we doing on IPOs? And if you had some suggestions on fixes to Sarbanes-Oxley, would there be any, and what would they be if there are?
I think for growing companies, the two most important things are they have scarce resources, so you really want to make sure it's not a question of, I wouldn't say get rid of Sarbanes-Oxley across the board. Personally, there are things I would get rid of about it, but it's really scaling to the level of risk. And so I think what the Jobs Bill did, for example, which is reduce the number of years of audited financial statements you have to provide when you go public, and remove the external auditor attestation around the 404 controls, those were both steps in the right direction. Because for a smaller company, those don't add almost any value to investors, and yet they add a lot of cost. And that cost is coming out of somewhere else, hiring an engineer or expanding into a new market. So I think continuing to really look at what have we learned from Sarbanes-Oxley. For a larger, more complicated institution, it may be that the costs are justified, but I think as you go down the curve, it gets into a much bigger question. I think a second thing that really came out during the debate over the Jobs Act is, do people understand small business? I think there's still in Washington policy circles a view that small business is really, really small. And the reality is that for these technology companies, you can get pretty big in terms of revenue and still be investing everything you've got in new products and not profitable.
I can assure you we don't understand small business. We're having a debate right now. The current debate right now was a small business tax reduction that could go to companies that have several tens of billions of dollars in revenue. So, but go ahead.
Oh, really? Well, that's probably a whole different problem. But I think the tendency is sometimes to cut off small business at a very low level. So I think Sarbanes-Oxley has a $75 million threshold, and that's just not really that relevant. I think something that slides is more relevant than saying small ends at a certain endpoint. And then the third, I'd say, which arguably is the most important, which is predictability. That in a sense, what people need to know is what they have to do, and they can cope with any reality. Different things will happen, and so, for example, there's some things that won't happen if the cost of doing them is higher, and that's a loss to our country. But at least with predictability, you can start to make investments that make sense. And I think that's what we're seeing play out right now in life sciences. There's so much unpredictability. The cost of getting through the regulatory process has increased so dramatically. And I recognize this isn't Sarbanes-Oxley, but it's that same theme of how much do we require companies to spend on extra levels of protection? And are we really sure that we're getting extra levels of protection that warrant that additional investment, recognizing that it's coming out of somewhere else? And I think those are the questions I'd really recommend this committee look at, because my guess is there's still more movement to scale 404, other parts of Sarbanes-Oxley, and regulation more generally back so that it hits companies with a responsible level of regulation.
One last question for Ms. Dent. You mentioned earlier that you all have the ability to lend against the likelihood of the next round of equity funding or next round of funding. Is that a choice that you make, or is there something specific to your bank that you've done that you could do that, or is it something that all banks could do if they choose to do it?
All banks could do it if they chose to do it. It really does take very deep relationships and a very deep understanding of how companies grow in order to do it well.
So that's not our problem, that's our issue, that flexibility exists in the marketplace already. Some choose to do it, some banks choose not to do it.
Yes.
Okay. Mr. Shipley, before we wrap up, and I'm trying to wrap up here by noon, you had 3 recommendations, and I want to make sure I got all 3 of them because I'm pretty sure I missed one. Talk briefly about your 100% exemption suggestion. The last one was develop education and training, and then I didn't even get the notes on the second one. So if you could maybe walk me through those for the record, that would be helpful, sir.
Sure. These are recommendations that are generally approved by the Angel Capital Association with our public policy group that we have as part of ACA. The first one was reinstate the 100% tax exemption on gains of qualified small business stock. And I think a number of organized angel groups saw a dramatic increase in investments that they were willing to make. I think they felt like they were on the clock, so they were pushing investments into that time period. Mm-hmm. So we think that if you made this a permanent part of the bill, that we'd get more investments in companies because people would be the idea in angel investing or venture investing or basically any kind of investing is to have greed overcome fear. And so if we think we can get enough return so that we're willing to make the investment in a company, and this is one way to help people step up to the plate and make that investment. The second point there, consider tax credits for angel investments. That's been a very successful program in our state and other states that are using investor tax credits in the state of.
We just passed the bill in South Carolina this week, I think.
Is that right? Yeah. In Ohio, we give a 25% tax credit, and we've had literally hundreds of millions of dollars invested in companies over the period of time that this has been in play. I know in the state of Wisconsin, which is part of the testimony, you can see the impact that it's had on both job creation and on amounts of money that angels have invested in companies. And I think from my perspective, we view it as a way to de-risk the investment in some ways, because as we've all talked about, the kinds of investments that we make, the failure rate is going to be about 50%. And these are stats that have been generated through studies that the ACA has done, where we surveyed literally hundreds and hundreds of deals that angels had invested in. And that 52% was the number that came back. So we invest in 10 deals, 5 of them are to be, we expect to write those off. So I think some people, they're going to invest in the deal not because there's a tax credit, but it's a little more icing on the cake. And if it is a failure, then we've got some of the money back by virtue of the tax credit. So I think that's been very important in our state. And the third point was in developing educational tools, training, and awareness programs for both investors and entrepreneurs. I think a lot of the panel members have talked about those issues, but certainly from an investor standpoint, to have more accredited investors who understand the process of angel investing. And when we first started, we actually created a one-day boot camp to teach prospective angel investors what it means to make an angel investment. So the ACA now offers those kinds of programs, which I think are invaluable, so that you teach people not only the process, but the fact that it is a high risk that you're taking, and so that they understand that risk profile before they start writing checks. You don't want an angel investor to write 1 or 2 checks, see those investments go south, and then declare that angel investing is not worth it. You have to understand that risk profile.
Thank you, Mr. Shipley. Last question, and it's to you, Ms. Jackson. You mentioned a suggestion, an idea you had about, at some point, companies that you termed vetted companies, that sort of received a seal of approval at some level of early equity financing would have better access to debt. And I'm just wondering if you have any suggestions on how the government can help that happen. Because are there regulations that need to change? Are there specific things that we need to do in order to encourage that type of behavior?
Well, I'll use a community bank as an example. We've run into lots of cases where there's the desire to support a specific company with a loan product, but the inability to overcome, some of the regulations in order to do so. Again, I'm not an expert in banking, so I don't want to go too deep on what specifically. But what I do see is an opportunity to have another couple of conversations to put people together. I think it's because of the failure rate, I understand why people don't want to loan money to this risk pool. But if we have a known behavior of selecting, nurturing, vetting, the least likely to fail, then is there something that we could do to get them a loan product? And is there any regulation that could be eased to make the community banks, for example, comfortable doing that?
Might I also offer one suggestion? There's a provision in the Dodd-Frank Act called the Volcker Rule that says that banks, it was intended to deal with very high-risky activities, proprietary trading, and investing in hedge funds in particular, private equity funds as well. And one of the issues before the regulators right now is, will it apply to venture funds? And that includes both venture equity funds as well as venture funds that provide credit, debt. And if it is applied broadly to all those funds, banks will no longer be able to sponsor or invest in venture debt funds. I think they're an incredibly important part of this overall ecosystem because they aren't regulated banks. They do have more flexibility to come up with some hybrid solutions that I think are more likely to be able to address the opportunity Ms. Jackson says. But if Volcker is applied broadly and all bank capital is legally prohibited from going into those funds, arguably the investors who are most able to understand and back those funds are now locked out of that. And so I would encourage the committee to join with other members. There have been a lot of members of Congress who have gone on the record saying that the Volcker Rule should not dry up equity going into venture generally. And I think that's an important thing because it will affect the very people who are most likely to solve the gap you're talking about.
Thank you, Ms. Dan. Thank you to everybody. I really appreciate you all taking the time to do this. I know that sometimes it seems that you spend all this time to come all this distance, as many of you have, and then you get maybe 5 minutes to ask questions or give your testimony and then get a chance to just do a couple of questions. And I can't underestimate for you the importance of what it is that you all do when you come and do this. What we're helping to do here is drive the debate. Inevitably, something that you said today, all of which goes in our permanent record, will end up being discussed in a trade association paper someplace, and then it turns into a discussion at the next symposium, and then it turns into something that somebody brings through an association to their member of Congress, and that's how we drive the debate. And I've seen that firsthand. I know then that sometimes you think it's a complete waste of time to come out here and talk for 5 minutes and travel for 3 days to do it, but I can assure you that it's not. And the opportunities we get to get your ideas on Sarbanes-Oxley and the Volcker Rule, the trends about the donative funding or whatever, I can't remember the term, but and then the experiences with the fraud especially has been very helpful, and we certainly do appreciate your input into the process. With that, since there's no objection because there's nobody else here but me to object, I will allow members to submit questions for 5 days after the hearing, and with that, we'll stand adjourned. I thank you for your time.